Vamos iniciar, então, trazendo para vocês a nossa parceira, a ICIS, que, na verdade, agora a pronúncia correta é ICIS. Temos que lembrar. E queremos apresentar a vocês a Amanda Rey. Amanda nos falará um pouco sobre como os preços e os fluxos comerciais do mercado estão influindo. Então, Amanda estão da editoria para as Américas da ICIS, cobrindo temas sobre mercado de commodities por mais de 4 anos, incluindo óleos básicos, olefinas e polímeros. Também já atuou em temas como a produção de shale gas nos Estados Unidos por 2 anos. Amanda, seja muito bem-vinda mais uma vez ao nosso encontro. Obrigado pela sua disponibilidade de estar aqui conosco. Fique à vontade agora para começar a sua apresentação.
Thank you, Pedro. Hello, everyone, and welcome. As you may or may not know, ICIS is a FTSE data and analytics company with more than 30,000 experts in 40 countries, including our team on the ground there in Sao Paulo. We cover petrochemicals, energy, and fertilizers markets with pricing reports, as well as our suite of supplemental analytics products. Our goal is to connect data, markets, and customers to create a comprehensive view of the global commodities markets. We were founded 39 years ago and have been covering base oil for the majority of that time. We adhere to strict methodologies, and our price reporting is audited every year to ensure that we meet standards and are transparent. On this slide, you can see myself and my colleagues who also cover base oils in the other regions. Sam Wright and Ashani Chavda are in Europe. Isam Ahmad is in the Middle East, and Matthew Chong handles Asia. In today's presentation, I'm going to discuss how we are recovering from the COVID-19 pandemic, refinery utilization and its impact on base oil, including its effects on supply, demand, pricing, impacts on trade, and expectations going forward. Before the pandemic, base oils markets were fairly predictable. The market had more than enough structural capacity to meet demand needs, and the US was very well positioned to supply growing needs of South America. The US prices did not move that often, usually 2 or 3 times a year, with seasonality or changes in feedstock prices. US suppliers would regularly clear out their surplus inventories into export markets, and often at discount prices. Brazil was a market that could benefit from this oversupply. Other key markets were Mexico, Europe, and India. And because of this oversupply, it was a buyer's market for much of the last decade. Where are we now? I think everyone knows that the market looks completely different than it did a year ago. When the pandemic lockdowns end, we had many concerns about the recovery, but they were demand-related concerns. We thought it would recover very slowly and in line with fuels demand because the factors are the same. Easing travel restrictions would boost mobility and the need for engine lubricants. That did not happen, and lubricant demand was mostly recovered as of late last summer. We are still waiting for fuels demand to fully recover. So the current problem is there is not enough supply to meet demand. Demand is strong in line with economic industrial recovery and the need to rebuild depleted finished lubricant inventories. This imbalance has caused monthly price increases, and the US does not have the volumes it once did to export. So Latin America especially will feel the impact of this because of its heavy reliance on US supplies. So how did the supply landscape change so drastically? The answer is reduced refinery rates. This slide reflects the US rates, but the same happened on a global level. US refinery rates in dark blue there on the graph, they've never been as low as they were in the last year. Lower crude runs in light blue columns mean that there was less feedstock available for base oils. So even though demand for lubricants had returned, base oil producers could not make more base oil due to the lack of the feedstock. A decision to increase rates depends on fuels demand, and refiners are matching their rates to that demand. So we are seeing better recovery in the US for fuels than some other regions, maybe due to stronger vaccination rates in the US. We've accomplished more vaccinations than some other regions. But with fuel demand still depressed, particularly jet fuel, there's still incentive to keep those rates lower. So you're not massively building jet kero stocks. So looking at the last 15 years of refining data on this screen, we see the 5 lowest points in terms of refining rate, which are reflected in the dark blue bar on the bottom. Each was driven by an economic crisis or a natural disaster. 2 of these points happened within the last year, highlighted in red. The first was COVID-19. These refining rates were slightly above 2008, which is the closest comparison we have for what has occurred in the last year. At that time, in 2008, the US was weathering a financial crisis, which crimped demand, and Hurricane Ike had hit the Houston area, and that shuttered production for a certain period. But the rebound was very sharp at that time. It happened within a couple of months. And today we are still rebounding, partially because of weaker fuels and partially because of 2 natural disasters that hit the US Gulf on top of the pandemic, one being Hurricane Laura and the other being the deep freeze winter storm that took place in February of this year. Hurricane Laura had dropped refining rates to around COVID lows, and the winter storm dropped them to 56%, which is a record low. The Gulf Coast was down to 41% at that time. So comparing last year and this year to date with a normal year, you can see that refinery rates are well below normal, about 10 to 15% below normal. Before the pandemic, a full year of utilization would average 90 to 93%. I've excluded 2017 in this comparison because of Hurricane Harvey. So I wanted to reflect years without a natural disaster or a triggering economic event. This is what normal utilization looks like. It was 78% in 2020 for the full year. And so far in 2021, we are averaging 82%. Crude runs are still off pre-pandemic levels, a little more than a year post-lockdown. And this isn't only the weak fuels demand. As I mentioned, it's also the 2 weather events that capped US rates. So refiners have battled shutdowns or insufficient VGO for over a year now. And it will be interesting to watch as gasoline demand further rebounds in the US. Rates are strengthening, but of course, fuels competes with base oil for the VGO feedstock. So even though base oil is the highest value product at the moment, it does not drive the refinery decisions. Coming into 2021, the US was very tightly supplied. And on the slide, you can see why. The full year production for 2020 was an 8-year low. It was 12% lower than the average output of the last 5 years. Suppliers had mostly pulled their spot offerings by the end of the year as they managed their contractual demand, and light neutrals were more available and being cleared into export markets. Not at the same levels as before the pandemic, though. On top of an 8-year low for full year production in 2020, Q1 production in 2021, this year, was also at an 8-year low. This is 11% below the average Q1 production. So US suppliers entered the deep freeze in a very vulnerable position supply-wise. The full impact of that storm is likely going to show in Q2 production numbers, which are not yet available because it happened at the very tail end of Q1. So COVID impact on refinery rates does remain an issue, but right now the US's larger problem is recovering from this polar storm, which could possibly be more devastating to the base oils market overall. The polar storm shut 42% of base oil production in the US, the same as Hurricane Laura. A key difference is wasn't planned for. Nobody planned for the winter storm. Hurricanes are expected. You build inventories, you shut down in an orderly manner to avoid damage. No one expected or planned for this winter storm. The shutdowns were not proactive, causing some damage in some cases. Restarts were more difficult and repairs took longer than usual because of supply chain shortages. Motiva, ExxonMobil, Holly, Frontier, all of these refiners saw severe impacts. Holly, of course, was already down for a turnaround, but the storm affected refinery equipment, so that was delayed and it took them a while to come back up. And this outage is one reason why bright stock continues so tight in the US. The US storm did not only affect refineries. Most blenders and petrochemical producers on the Texas Gulf Coast also shut, again, unplanned, many of them. So everything that affects the lubricant blending operations, base oil additives, packaging materials, all the plastic that goes into packaging, all of those supplies suddenly went very, very short. And this continues today. US manufacturers are dealing with 2-month order backlogs or more, material shortages, logistics delays. And this is a time when they should be building excess stocks for hurricane season against some lower demand. So hurricane season is predicted to be more active than it usually is. So this is how far lubricant stocks fell. You can see in the red column there at the end. This is a 5-year low, a 5-year monthly low. So every month for 5 years is reflected on this slide. Refiners are not in a position to build any hurricane insurance. They're catching up on orders. If you were to place an order today, you may not have it shipped until late August. That is how bad it is as far as backlogs. Most will not have spot supplies this year or taking on new customers. So this is a condition before hurricane season becomes active, which is usually in late August. A major hurricane like Harvey or Laura would be devastating and set it further back. As I noted earlier, it is important to watch fuels demand since that is what drives the normal refinery operations. This is a good indicator of when the US may return to more normal refining. The short story is that demand is coming back for gasoline and diesel, but refineries are going to be limited by jet fuel for the next couple of years. Aside from jet fuel, petroleum product consumption is rising in the US, supported by strong economic growth here, seasonal factors, summer driving, pent-up demand as the pandemic restrictions ease and more people get vaccinated. So for gasoline, we saw about a 14% drop from 2019 to the full year 2020. And we expect 2022 demand levels to still be roughly 5% below 2019. Some of this expected to be weighed down by permanent changes in work policy, more people working remotely, companies making decisions for hybrid or flexible work, whether you're on site or at home. Distillates demand is lagging gasoline somewhat at this moment because of supply chain problems such as truck driver shortages. The 2019 to 2020 drop was 8%. It was less than gasoline. But the 2022 demand levels are expected to be roughly around 2019. So this will recover with industry. Jet fuel, of course, the slowest to recover. We expect permanent changes in business travel as virtual meetings such as this one seem to be taking place more often or in place of an in-person event. The COVID impact on jet fuel demand from 2019 to 2020, there was a 40% demand drop. Jet fuel still expected to be 8% below 2019 demand levels in 2022. So it has a ways to go still. We don't expect it to fully recover until international travel opens more widely. Until then, refiners do not want to build those jet fuel stocks. It's a small portion of the refinery product, but very high value in normal times. So before the pandemic, refiners would do what they could to maximize that production, and now they have to do the complete opposite and minimize that production. So they've already done what they can, and they still need to manage rates to keep stocks in check. And this is going to affect the other refined products as well. Feedstock prices. These have been less of a factor in pricing decisions of late, but you can see here on the dark blue line that they began to rise in November of last year. And that aligns with when base oil prices started to rise in the US. Crude inputs are roughly up to the level they were immediately before the crash. Low points highlighted here in red. But this is, remember, this is only the US, so fuels demand is a bit stronger here due to stronger vaccination rates. But just to show that VGO is a driver, but it is not the only driver of the prices. Higher costs and the supply and demand imbalance, more so the imbalance of the last year, has resulted in this unprecedented pace of increases that we're seeing in US base oil. Everything is up $2 to $3 a gallon, and we've never seen this level of high pricing without crude prices also being much higher than they are now. Prices continue to rise in the US even while they are stabilizing at high levels in the other regions. But the US is also more constrained on the production as they catch up from these production disruptions due to the storms. The impact of tight supply on assessed prices has been very clear, especially for the tightest grades shown here, which are bright stock 600 and 4 cent stoke. These have more than doubled from COVID lows. Bright stock has reached record levels in ICIS price data history. Heavy neutrals in Group 3 could also reach record levels. Again, it has not been this disconnected from crude before. VGO is plotted here on the gold line. This is entirely supply driven. Pressure continues on all of these grades, but there's no volumes really available for the spot market. There are not many indicators of improvement. Suppliers are focused on their contract customers first and even have some limitations there. Group 3, mostly not produced in the US, is the tightest because of feedstock issues in producing regions. And this tightness is having some impact on Group 2 plus supplies as blenders look to use more of that 2 plus amid a shortage of Group 3. So the US is not clearing its surpluses into the export markets because it doesn't have any to clear, but demand is strong from other regions. South America sources 85% of its regional supply shortfall from North America, according to our databases. So changes in availability from the US are going to have a significant impact. South America is one of the first places that US suppliers did see a return in demand. And you can see strong volumes from June onward in 2020 reflected in the light blue bars on the graph on the left. Brazil was a large driver of that demand. Amazingly, 2020 export volumes from US to Brazil were down only 2% from 2019, despite the COVID impact on demand. And so far this year, the US isn't exporting as much material because of tight supplies. You can see in the green bars on the graph on the left. But outside of some light volumes that went to India earlier this year, not much has been done outside of a contract basis. US exports to Brazil are up 23% year to date in 2021 versus 2020. So the demand is very strong for US material, and US suppliers are struggling to meet that and want to meet that Latin America demand, and are hoping to get back to more normalcy so they can do that. How have US export prices responded? These prices I'm showing here, 220 and 600, they normally reflect true supply and demand balances in the US markets. Before the pandemic, they were often 20 to 30 cents below domestic prices. They fell to 50 cents below domestic prices in May of last year at the depth of the pandemic. Producers were selling material around $1 a gallon into export markets just to get rid of it, since nobody needed it. Now we have seen a strengthening in exports and carrying a premium even to domestic prices of 20 to 30 cents. So a reversal, and the question will be, is this a new normal for export prices relationship to domestic prices? I'll wrap up by going over a few expectations we have. We don't expect a return to an oversupplied global market anytime soon. Fundamentally, we have too much capacity than we have demand, but the tightness we've seen over the last year, the effects of it are going to linger for some time. US suppliers are going to be focused on their contractual obligations first. There's little to no spot available in the near to medium term. We do see an uptick in people signing contracts from regions that previously bought on a spot basis to ensure the security of supply. There will not likely be any significant spot exports from the US this year, although maybe some ultralight material. Supply chain shortages may lead to continued strong demand in the foreseeable future as buyers may want to increase their offtakes under their contracts to ensure finished goods are continuously supplied. Crude runs, again, we do not expect to recover to previous levels yet until fuel supplies are, or fuel demand rather, is back to normal level. Supplies are fairly ample right now, and there's still no need for jet fuel, no great need for jet fuel. With tighter supplies, this should offset lubricant demand declines that were previously expected and we still expect to happen due to electrification. But balances may be slightly tighter over the next few years than we may have previously expected before COVID. That is all from me. I appreciate the opportunity to speak here. Thank you, Pedro and Gustavo, and thank you for your time. Don't hesitate to reach out to me personally if I can be of assistance, or any of my colleagues I can introduce you to as well. And I'm happy to take any questions.